Hi, welcome to our YouTube session. This is Abhijit Chatterjee and Rohan Singh. We are recording this on March 28th. Today was the last day of the month. So in this video, we will cover the market update, what happened for the month of March, what happened this particular week, and also what happened over the last 5 months rally that we've seen since October bottom. We'll also talk about the QQQ, which is the key sector that has had an outstanding rally. And finally, discuss bullish percent index. That's a way to measure market breadth. And the bullish percent index of the comparing the S&P 500s, bullish percent index to the QQQ, the NASDAQ 100s. In particular, the market breadth being very different on the S&P 500, which is a more diversified index, versus the NASDAQ 100, which is the top tech 100 stocks in NASDAQ. So with that, let's just talk about the blog site. I welcome all of you to take a look. It's a very simple URL to remember, chartsarefun.substack.com. Our service is called Charts Are Fun. Our goal is to make chart reading fun, to apply that into your investment decision making. And we are not investment advisors, so we're not here to give you investment advice, but we want to kind of make the process of chart reading fun so that you can then apply it as insights to your trading decisions. So that's our simple blog site. The archive click will give you, we try to publish blogs every day. So the 5 blogs or the 4 blogs that we published this week. Tomorrow market is closed, so we are not going to publish a blog tomorrow. But Monday through Thursday, these are the 4 blogs that were published. Also, I want to point you to our YouTube site. Would love for you to subscribe to this. Just hit the subscribe button right here to subscribe. And also, if you like any of our videos, we really appreciate if you could like it. So this would help us kind of share this to a wider audience out in the YouTube community. So it's a simple site to remember as well, youtube.com at Charts Are Fun, which is our channel. So now let's look at what has happened in the market. And this is a quick look at the 6 or the 5-month rally that we've had since the late October lows in the market. If you look at the 11 sector ETFs, in this case, the stock chart site allows you to compare 10 of those. So you left the real estate out and take in the remaining 10 sectors. The leader, as you can see, and these are all sorted right here on the left-hand side in the legend. So financials, XLF, was the leader at 32.65% over the 5-month time period. So starting from late October till the last trading day of March, which is today, we got a 32% plus climb in the financials. Second, right after that was the industrials at 30.5. You know that the Inflation Reduction Act has gotten tremendous amount of government support in the infrastructure business. Many of the companies are out there benefiting from it. And there's just been overall kind of transports and various other sectors in the industrials. GE in particular have been absolutely great. And then the technology sector, which you would have thought to be the leader, is not that far. It's at 30.5% for the 5 months. And that's, as we know, with the AI euphoria, started off with the Magnificent 7, which are the top 7 moving stocks in the NASDAQ 100, came down now to more of the top 4. So Magnificent 7 morphed into Fabulous 4. And the Fabulous 4s really are looking at Microsoft, NVIDIA, looking at Meta, and then Amazon. Those are the top 4 that have done extremely well. Google actually was a bit of a laggard in February, but it outstandingly made a recovery in March. So you could say that the Fabulous 4 is actually Fabulous 5, because if you look at the performance across these 5 months, these 5 stocks did quite well, closing all towards the highs of the 5-month time period. And then the laggard for that 5-month was actually energy, so which is XLE. It was only up 10.8%. And right above it was the utility, which is a defensive sector, only up 11.6%. Now, an interesting perspective is this is the 5-month duration. Over the 5-month duration, we saw the leaders being the financials, the industrials, and the technology. And communication actually was number 4, also very close to 30%, 29.6. And we know that communication consists of the internet stocks such as Google, such as Meta, and so on. Now, the laggard here, which is the dog, the energy, turned out to be just the reverse when we moved into the month of March. So now we're looking just at the 1-month performance, and guess where the leader is at over close to 10.5% gain for the month was energy, XLE. Utility, which is also a laggard in the 5-month performance, became the second best performance. And utilities tend to have a seasonality effect in March. It tends to do very well in the month of March, and here it was number 2 at 6.59%. And the laggard to the bottom two, actually one with ended negative for the month, was the discretionary XLY. Discretionary is where Amazon, Tesla, some of those discretionary retail stocks fall under that as well. And second in the bottom was the technology sector. Isn't quite a surprise? Here we have the AI euphoria. Here we all talk about, well, this is an AI-powered rally. We have the Magnificent Seven driving the market higher. Yet for the month of March, leadership changed. The sectors that came up to the top, which often happens in the late stage of a rally, by the way. In a late stage of a rally, a typical phenomenon of a rally is it starts off with some of the leaders. And as the rally matures, the leaders start giving way to laggards coming over and getting some money, getting some love from the investors. And that's exactly what happened in the month of March. Energy became a leader, followed by utility. And actually, basic materials also did extremely well. In particular, copper has been doing really well of recent, and some of the basic metals as well. And XLB, the materials sector, also closer to 6.5% gain. So here, the technology XLK and the discretionary XLY were the laggards. And it's quite interesting knowing that. Let's look at the core ETF that has actually done an outstanding job in terms of the overall 6-month rise, almost close to 30%, which is the QQQ index. So a bigger picture of QQQ is, if you look at, in this case, a weekly chart, every candle here is a week. Start off from the left-hand side of the cup at 401.89 from late 2021, the peak of QQQ, a pullback, a pretty, a strong pullback came to the 250 region around October of 2022. That was the bottom. And then that's when the cup base formed, and then it came back to the top of the right brim of the cup at 385, right around July of 23. So that cup from 401 on the left brim, 251 on the bottom, to 385, and then a handle, a shallow handle pulling from 385 to 341 around the late October 2023 timeframe, is where the completion of the cup and handle pattern, and then the breakout happened. And when the breakout happened, we can measure a target at 520, taking the top of the cup 385, subtracting it from 251, and like it's almost 386 was the 385.93, so I can round it up to 386 from 251. That's roughly, you're talking about 135, 134, 135 points. 134 to 386 is 520. So that's the measured target. However, nothing goes up in a straight line, and something very interesting going on, and this is a weekly chart at the end of this week, is we're starting seeing the PPO, right? PPO is a measurement of the market's momentum. It's also a measurement of what is the market doing with respect to its similar as a MACD. It looks at the 12 and the 26 week moving averages and the closeness of those two moving averages. So here we start seeing a crossover, which is a bearish sign. Often a bearish sign is in a correction or a pullback happens when you have so just like here, for example, when the MACD crossed over and the black line went below the red line, for those 3 weeks from July, 3 months from July to October, we saw the market pull back. In a similar way, when you see that the MACD crossed over and then this was a longer duration from the beginning of 22 all the way down till June, July of 22, that was for 7 months, you could see that the market pulled back. So typically PPO crossovers, bearish crossovers where the black line goes below the red line is a correction in the market. So that is an early sign. We have to watch what happens after a core market moving data point tomorrow, which is Fed's favorite barometer of inflation called the PCE. Tomorrow, that's the personal consumption expenses. The personal consumption measurement of inflation is going to be coming out tomorrow. That's when the market is closed tomorrow, so we can't act on that data. However, that number is expected to be hot. And if it is hot, this could be a market moving event on Monday. And hence, this is something to watch in terms of longer term target, no question, is 520, but with a bearish cross of the moving averages, the 12 and the 26 ending the week, and a negative divergence, a slight negative divergence, a lower high in RSI as the QQQ climbed the higher highs from all the way up to 449 last week. And this week, we wasn't able to make it up to 449. It kind of maxed at 447 and closed near a perfect 444 number, 444. So that's the longer term picture, the weekly chart looking towards where are we headed, where's the destination of QQQ. Now taking a look at an hourly chart of QQQ and looking at an understanding of, before we go to the hourly, actually, let's move and look at the daily chart. And the daily chart here, where every candle is a single day. The previous chart here, every candle that you see here, a hollow candle or a filled candle, are all a week of trading. Here, every candle that we're seeing is a day of trading. Now we see a beautiful rising channel, starting off from the left, as in the October low at 341 to the recent highs at 448 and 449. It came up the channel. Initially, we could see that it climbed up, hugging the top of the channel. Then it pulled back to 394 from 412 towards early 2024. Since then, it came back to the top of the channel. And then from middle of February onwards, we see a very different pattern. It no longer is going there because the top of the channel keeps rising over time. And that's now over 450, 460. It's no longer trading in the top part of the channel. It's now trading in the bottom part of the channel till very recently, which was right in the mid-March. It actually broke below the channel with heavy volume. So 2 heavy volume days as distribution days with bearish looking candles here. You can see these dark red filled candles. Those are bearish looking candles with heavy volume. Was an indication of the market about to break down. However, the bulls rallied it back up, not to the top of the channel, but towards the midpoint of the channel. And since then, it's been kind of gravitating back down a little bit, but kind of ended somewhere in the realms of the bottom part of the channel. But this part here, RSI, clear negative divergence with RSI weakening, lower highs as the price is climbing, lower highs in PPO, which is another indication of negative divergence, are indicators of momentum, showing that the market's momentum is weakening as QQQ is climbing. Now, going to a shorter term picture, as in every candle here is actually an hour of trading, and this is all of the month of March, literally. You can notice that QQQ touched 448 towards early March, pulled back to 432, and then came back to 449, a buck off from the previous high, towards like March 21st. So in a span of March 8th to March 21st, we found a beautiful cup, and then a shallow pullback from 449 to 441.93 as the handle. Now, there is a possibility that if the data tomorrow, which is the PCE data, inflation data, is not as hot and is actually showing some inflation cooling down, it would raise markets' expectations for the 3 cuts, make the market more confident about the cuts, and market loves cuts, loves rate cuts. That would potentially cause a cup and handle breakout on the hourly chart. And that number, if you look from 449 to 432, that's 17 points. Add 17 to 449 goes to 456. So there is a possibility that while we are seeing some potential bearish patterns on the weekly chart of QQQ, on the daily chart, kind of hugging the bottom part of the channel, this could turn out to be a head fake and we could get a breakout back higher. Now, what are the indications that this breakout could come? A key part is if you look at the cup as it formed from 448 to 432 back to 449, the right part of the cup has a higher RSI than the left part of the cup. That's a bullish divergence, it's not a bearish divergence, as in there's momentum. There's higher momentum in RSI compared to the left part of the cup as the right part of the cup. Also, look at the PPO. PPO is at a higher high than the left part of the cup. So there is positive confirmation of the right part of the cup, similar levels as 448 and 449, but RSI at a higher high, PPO at a higher high, confirming that the bull run perhaps continues on QQQ. And the pullback, when RSI pulls back and does not go to 30, hovers in around the midpoint region near 50, and then the worst it pulls back is towards the 40, and then still hovers around the midpoint 50. That's also a bullish sign. That shows consolidation of momentum, consolidation of gains with some pullback, digestion, and then another break higher. So there is a possibility that based on the data tomorrow, we could have a big breakout in QQQ above 450 on Monday. So that's the bullish possibility. And then on the weekly chart with a bearish crossover of the PPO, as which we discussed here, there's a possibility that this could actually, if it's a hot data, it could turn the market lower and QQQ could pull back. So that's the trends on the QQQ. A key sector that has led this market higher is another barometer we are watching is the semiconductors. Semiconductors also have a beautiful cup and handle on the weekly chart. Every candle here is a week of trading. 156 on the left brim, 82 on the bottom of the cup, 160 on the top of the cup. So 82 to 160, that's right there, 78 points. Add 78 points to 160, that's 238. So 238 was the target, the cup and handle target of SMH. Did it meet it? Absolutely, it met it. So towards, if you look at right at the beginning of March, our last part of February, it met the 239 number. So it exceeded it, and that actually happened the day NVIDIA's earnings came out, right around that time. So it exceeded it, and then from there, it has pulled back, but hovering around from the 239, it's pulled back as low as 212 and closed near 225 today. So that's something to be thought about, that perhaps the semiconductors have kind of met their target for now. Semiconductors be a bit of a laggard, while other sectors in QQQ or other stocks like software or others could be taking a lead to move the market higher. Though my gut says that the leader of this rally has been NVIDIA. If the market does break out on Monday higher with QQQ crossing over 450, there's a good chance NVIDIA will again catch a good bid, and so will SMCI, which is now in S&P 500, also catch a decent bid, which is the Supermicro, one of the big server manufacturers of the AI rollout that we're seeing across industries. So that sums up the market, sums up the thoughts on the market for the month of March, for what happened in the 5 months, and then expectations moving forward. The next section, I'm going to talk about something very interesting. There is this pattern, which is, while we talked about market momentum indicators with relative strength index, RSI, and PPO or MACD, kind of measuring the price percent objective, another index that measures the breadth of the market, breadth in this case, the bullish breadth. What percent of stocks in an index are actually showing bullish signals? The bullish signals here are measured by something called not a candlestick pattern, but something called a point and figure pattern. A point and figure pattern is what is here. It is a column of zeros and X's. Columns of zeros indicates selling, as in the price coming down. Column of X indicates buying, as in price going higher. So it alternates. It comes down, then it goes up, it comes down, then it goes up. And a typical buy signal comes in this point and figure chart when the previous column of X's is broken higher. As in, you saw that we had a column of zeros, then a column of X's came, then we got a column of zeros. But this column of zero did not break below the previous zeros column, right? The previous zeros column was here. It stopped here, right above the previous zero. So that means it's a higher low in price. And these columns are, by the way, all indicated in price. So if you notice here, these are all price. And depending on if it's less than $100, these are typically $2 price increments. So each of these, if you look at these small cells that are drawn out in a graph paper kind of format, each of these small cells are actually $2 in price difference as you go from the bottom to the top. So here, when the buy signal comes, when a column of X's takes out the previous high of the column of X's. So this column of X's was here, and then the price momentum caused it to break above that. That's a buy signal. A sell signal is just the opposite. So here we went up, then we came down with the zeros, then we went up, then we came down with the zeros. But this time when we came down with the zeros, we broke below the previous column of zeros. As in, we have a new zero that printed below the low of the previous column of zeros. So that's a sell signal. So when you look across all the stocks in, say, NASDAQ 100 or S&P 500, so 500 stocks in S&P 500, 100 stocks in NASDAQ 100, take all the stocks, look at their point and figure charts and say, is it reflecting a buy signal or a sell signal in terms of the most recent set of X's or zeros that it has in its column? And if you say, well, 90% of the stocks in S&P 500 are reflecting bullish pattern, that means that the market's breadth from a bullish perspective is very bullish. 90% of stocks are moving higher in a bullish trend in a point and figure, and that indicates that there's strength in the market. However, if the market weakens, its bullish strength starts weakening, what happens is the percent of stocks that are showing bullish pattern starts putting lower highs. That means that the market is weakening. The leadership in the market is weakening. Fewer stocks are moving higher as the market keeps moving higher. So now With that as the basic cost concept, let's look at a simple comparison of the S&P 500 versus where we are with the NASDAQ 100. What do you spot here visually? This is, by the way, this chart does not use time in the x-axis. It just draws the x-axis and with succeeding columns of x's and zeros based on price movements. So how do we read this chart? Well, each of these numbers that you see here are actually time indicators. They are 7 means July, 8 means August, 9 means September. And then from September, so you went from 1 to 9, and so there's no zero here. 1 to 9, 1 is January, 9 is September. October becomes an A, then November becomes a B, and December becomes a C. So it goes a 1 to 9 ABC, 1 to 9 ABC. So you'll see here 1 to 9 ABC, that's the month of year of 2021. Then for 2022, 1 through 9 ABC, then 2023 and 2024. What is fascinating is because there is no, other than just labeling the year on the x-axis, each column of these cubes are not months, by the way. They're price movements. So here, how do I read this chart? This chart I read by saying that the beginning of 2020, this is actually 2020. At around 2020, there was a big drop where bullish percent from 90 came down to 48. Then from bullish percent went from right above 48. And by the way, the reversals are pointed, they call it a 6-point reversal, as in you have to have 3 cells of movement for it to switch back from a downward movement to an upward movement. So here, from when it touched 48, it had to basically go to 48 plus 6, 54 and higher for it to switch back higher. And whenever it can get a 6-point move from the low, it switches back and then the trend starts moving higher. Again, a 6-point move from the high to the downward in the negative direction, then the zeros start coming. So here, bullish percent index of S&P from 90 came down to 48. Then it started moving higher all the way back to 80, a lower high from previous value at 90, that is market is weakening. Then from there, it dropped all the way to a lower low, right? So that means from 48, it came down to 42. Market is weakening. It went back, but couldn't climb as high as the previous 80. It only came as high as 72. Then another drop. So that's how you read this. Zeros means drop, X means going up. Drop, going up. So bullish, in this case, the bullish percent is actually narrowing down from a lower lows and lower highs. And in many ways, this is also called a pennant shape or a triangle shape. Interesting enough, that happened. And then typically, there's a volatility squeeze. Whenever you start getting that in prices as well, but in this case, we're seeing it in the bullish percent of S&P. It come to a point where it became very narrow and boom, it broke out higher, right? So the excess means it broke out higher, back towards 84. Then again, it came, and then here we notice it kind of narrowed down into 2021. And that's when the rally kind of started narrowing down in 21. Remember, the bullish kind of the part of the rally kind of started getting weaker and weaker. And then look at beginning of 2022. 2022 began right around here, right? As 2022 began, we had a big drop in that month of January, and the zeros came right after. Then a slight recovery into February to March, then another big drop, and so on. So right now, where are we in S&P 500? We can see that the bottom is this blue uptrending line. It's right far about 26 to 28 was what we touched towards late October, right? When the bottom happened in the markets, right? It fell to 20, almost close to 24. And then it rallied big in the month of November and December from 24 in bullish percent. It went as high as 80, right? That's where the bullish percent topped out for S&P. And then it came back down in the month of January. So you see 1, that means January has started. The zeros start printing. Then you printed 2, which is February. From February, we went back up for 3x's, right? So that means market breadth, the bullish percent from 64 went up to 72. And the fascinating part is, in March, that means when 3 printed, only 1x printed. That means it's been such a tight range of bullish percent. That means it's been holding steady. Roughly 76 to 78% of the stocks are printing, no, it's about 74% of the stocks are printing bullish patterns. So in that 72 to 74, in that 2-point range, market, that 2-point range is in 74% of the stocks are printing bullish. So overall, market from an S&P 500 are showing quite strong relative strength in terms of number of stocks looking bullish in terms of these charts. However, completely different pattern on the NASDAQ 100. That's the technology heavy. A biggest part of that move happened right, by the way, if you look at 2024, right at the beginning of 2024, in December, it had a big climb from 32 in the bullish percent for NASDAQ 100 to up to 90, right? That's the big move of market strength happened in December, and then the fizzling happened, as in the weakening happened. Moving into January, we got a column of zeros. That means the bullish momentum from 88% of the NASDAQ 100 being bullish came down towards 70. The slight pullback to a lower high at from 90, you went up to, say, roughly 82, came back to a column of zeros to a lower low towards 58. Had a slight reversal with a column of X's. And then March came, and look at the weakening of momentum in March. And that's why XLK, which is a big part of NASDAQ 100, closed toward the bottom of the month. Remember when we showed you the bottom of the month? For the where is the two most in the bottom of the month is the discretionary, which is also a big part of the NASDAQ 100. Amazon, Tesla, those are all part of NASDAQ 100. And the technology, XLK, the technology ETF, you can see is the bottom. That is manifesting beautifully in the bullish percent chart. And this is what you see that for the month of March, unlike the S&P 500, which holds steady right there, right? And the steady there shows that the breadth of the S&P 500, 72% of the 500 stocks, means 350 stocks are actually staying bullish for the entire month. But the remaining 150 stocks are actually where some of the technology-related stocks are weakened over the month. And that's why the NDX, which has 100 of those S&P 500 stocks almost, weakened all of March with a big column of zeros from starting at 66, came down to 46. Then we got a kind of bullish recovery, but not to make up to the previous highs. It did not go across the 64. It kind of topped out at 60 and ended near 56, almost at the midpoint. That means half of the NASDAQ 100 stocks are now little more than half. 56% of the 100 stocks are bullish. The remaining 44 stocks are bearish. And that means that if we get a pullback from the month of April, so starting next Monday, you'll see a number 4 print because that's the month of April. And then if we go into you need a 6-point reversal, right? We're almost close to a 6-point reversal. So the high was 60, we are near 56. That's a 4-point. If it becomes 54 and lower, so 6-point reversal, as in from the previous peak at 60, you get 54 and lower, a column of zeros will start printing. And that column of zeros, if it goes below the 46, then it's a bearish trend continues. Why? Because now it's below the previous lower, so it's a new lower low. And that's something to watch because that would mean the market could have a pullback, the much needed pullback, and technology could be leading in that pullback as we get that into the month of April into May. With that, thank you for your time. It was fascinating to share some of the new concepts of how to use bullish percent to read chart patterns, and then just the overall expectation of what the market is showing right now. To recap again, we had fascinating climb of the core sectors, financials, industrials, technology, and communication, close to 30% for the 5-month climb. However, as we looked at the month of March, what underperformed was actually some of those leaders, such as technology and discretionary. But the claims were so strong into February that overall over the 5-month period, they still, compared to that low in October, it's a relative comparison, right? It still holds a 30% gain. But for the month of March, technology closed almost flat, less than 1%, and discretionary closed negative, minus 0.06%. QQQ, cup and handle, long-term picture going to 520. However, near term, the daily channel is weakening. We are kind of close to breaking the bottom of the channel. So that's something to watch. 2 heavy volume distribution days in March. That's the negative divergences in RSI and PPO. Printing lower highs means market in some ways is showing topping patterns in QQQ. One bullish pattern in here to take the devil's advocate and say, well, what if the market goes the other way? Yes, there's a possibility. Looking at a short-term hourly chart. Why? Because of this cup that is beautifully formed, had high volume on the right-hand side of the cup, had higher RSI and higher PPO compared to the left side of the cup, higher RSI, higher PPO, and on the strong volume, means that this could be a potential cup and handle because we got a shallow pullback from 449 to 441. That handle, if it breaks higher, measures close to 456. So that's a decent upside, breaking above 450 and going all the way up to up to that pattern. Actually it's not 456. It's the did the math wrong. It's 466. So if you look at 432 and 449, that's 17. Add 17 to 449, that's 466, not 456. So that's the upside potentially on this hourly cup and handle. Semiconductors have met their cup and handle target from a long-term chart. From 160 to 82 is 78. Add 70 to 160 is 238. It touched 239. So it's kind of met its target, not expecting much from semis for the time being. And finally, the key thing about looking at markets breadth from a bullish perspective, S&P looks relatively more bullish than the NASDAQ 100, but the NASDAQ 100, as you could see from the Excel case performance, is weak.